Hi, as part of Credit Training Inc.'s powerful analytics program, the credit library here will be discussing a write down and what is a write down, how to navigate a write down on a financial statement. All right, so let's get started. So to start with, what is a write down? A write down is related to accounts receivable, trade AR, as opposed to bad debt expense. All right, let's talk about that for a second. Bad debt expense is an estimate based on historical findings related to an AR aging and how much of that AR aging is typically not received year over year. So it's typically around 1% of the AR aging that a company will expense on the income statement as bad debt expense. So bad debt expense and a write down have the same impact throughout the financials, but they're for two different situations. One, the bad debt expense is an estimate of what's expected to not be received with regards to the accounts receivable based on history and what has happened historically. But a write down is a specific understanding that a certain account in the accounts receivable will not be received, or there is a very high probability that it will not be received. All right, so let's take a look at an example. One that I like to use because it makes sense is in the restaurant industry. Not too long ago, when COVID happened, clients in the or businesses in the restaurant industry struggled, and when they struggled, if they were buying from distributors of whatever product, ketchup, whatever the restaurant needs, they would owe that money to that restaurant and maybe to that distributor, and that distributor possibly could be your client. All right, so let's use that as an example. Your client is the distributor. The restaurant, the distributor sells product to that restaurant, and now that restaurant owes that distributor, and the distributor is your client. All right, so in this situation, COVID happens and the restaurant fails, right? It goes under, and then the restaurant owes your clients, let's say 400,000. Now the total AR we'll say is 2 million. So this is going to be for trade AR, 2 million. And that restaurant owes your clients 400,000 that now they're saying they're not going to be able to pay. So AR is going to decrease by 400,000. So what's left is 1.6 million. So that AR is going to decrease. That makes sense. They're not going to receive that AR, so that AR is going to basically vanish. It's going to go away. So we go from 2 million to 1.6 million. But there's more to it. There's more that impacts the financial statements, and we really need to understand in financial analysis how the financial statements connect together and how one event can impact all the financial statements. And this is a great example. So what occurred when that 400,000 was added to AR? There was a sale, right? It was revenues, and that $400,000 sale, the cash was not received yet, so it became AR. All right, so there was product sold. The restaurant bought $400,000 of product from this client of yours as a bank, your client, and it became $400,000 of AR. Banks lend on AR, that's the collateral, and the clients need capital because they're waiting to get paid. So where it was revenues and became AR, now, since it's not going to be received, it needs to be unwound, all right? So what's the opposite of revenues? To unwind this, we need to know what is the opposite of revenues is expense. It's an expense. So the expense of 400,000 here goes to a write down here, and it's 400,000. So it's going to be expense through the income statement, which is the opposite of when it was sold. It became revenues. Now it's being unwound. Now it's a $400,000 expense. The write down is now this expense. And what happens when expenses increase? Profits decrease. All right, there will be some tax advantage to it. It's not the way companies want to pay less taxes, is to have a write down, not receive their AR. They prefer to receive the AR and pay taxes on it and be all set. But when it was revenues, they paid taxes. Now we're unwinding this, and it's a write down. It's an expense. So expenses decrease the tax obligation. So to the net income, it's not a $400,000 decrease, but it might be $300,000 or $320,000 decrease because there is a tax benefit there. Again, not the way a company wants to have a tax benefit, but it is a tax benefit. So net income decreases when expenses increase. So the expense increase, net income decrease, and net income is related to retained earnings here. And retained earnings is part of equity. So since net income is going to decrease, retained earnings is going to decrease. So equity is going to decrease here. All right. And what is equity related to? Equity, if the real basic leverage is liabilities over equity, real back of the envelope, there's a much longer leverage ratio that needs to be understood and used. But just for conversation purposes, it's liabilities over equity. And if equity in this case is decreasing, as we see here, equity is decreasing, that means leverage is increasing. All right, so we have leverage increasing here, and that's this right here. Leverage goes up, and excuse me, leverage goes up. And I like to talk about always leverage and liquidity together. Leverage and liquidity. What is leverage? Leverage is the long-term viability of a company. How likely is a company to survive in the long term? Liquidity is the other side, the short-term viability of a company. How likely is a company to survive in the short term, right? Company could have really good leverage, but really bad liquidity, and they're able to, in the long term, they look good, but in the short term, they don't have enough liquidity to carry them in the short term, and a company can fold that way. So it's great that the balance sheet, it's so amazing. The balance sheet has leverage and liquidity and shows both the long-term and short-term viability of a company. So I always look at those together. I kind of think of it as peanut butter and jelly. Peanut butter is great, jelly's great, but together it's really awesome. And that's how we should look at leverage and liquidity. Always look at it together, at least to begin with. And then if there's an issue with one, then we get more into that one item. So leverage may be great, liquidity not so good. Now we're focused on the liquidity. But to start, we talk about it together. That gives the overall financial condition of the company, which is the balance sheet. And the two primary parts of the balance sheet is leverage and liquidity. So we said leverage went up. And then over here, when the AR, when we knew it was going to decrease, because it's no longer going to be received, that 400,000 AR decrease. Now I could have said right there that liquidity would decrease, but again, I like to keep leverage and liquidity together. And now I'm saying leverage increases, liquidity decreases. I put those two together, and there's it's recorded. This 400,000 is recorded as a non-cash event on the cash flow statement right here. And I know it's a non-cash event. Basically, this write down. No cash exchanged hands when the company, the restaurant called your client and said, I'm not going to be able to pay. No cash exchange hands. All right. We're unwinding that revenue that now became an expense, but it's a non-cash event expense. And we know that because it's over here under non-cash events under the cash flow statement. So here we're seeing there's 7 items. All right. And we'll go through it once again. You get the call, and your client is calling you, telling you this, but they get the call and they find out that their AR is going to decrease. That's step 1. All right. All of this happens, I should say, all of this happens at the exact same time. I just put it in this order so that it's memorable and it makes sense. There's a logical step process to making sure we captured each component of the write down. So AR decreases. The second is the expense increases. Third, expenses increase, so profits decrease. And when profits decrease, profits are connected to retained earnings and equity. So equity decreases, that's 4. And when equity decreases, leverage increases, that's 5. And when the AR, when it was found out that the AR was not going to be received, AR decreases. So that decreases liquidity. That's 6. And It's a non-cash event, and we know that because it's recorded over here in non-cash events on the cash flow statement. So I like this marking here where we go like this, and it looks like a 6. All right. And there's 7 items. So this helps us remember all the impacts of a write down. Keep in mind inventory. If inventory and equipment are having a write off, we call those impairments. Okay. For both of those, I like to use an example. If someone's driving a fork truck and they run over the inventory, that inventory is now impaired. That can be expense on the income statement. And then the same process happens. Step 3, step 4, step 5, step 6, step 7, all happen the same way. Just a write down is for AR. Inventory is called an impairment if there's a problem with that inventory. And say a fork truck runs over the inventory, impairs it, and then the driver of the fork truck backs up quickly because they get surprised and they run into a machine, the equipment, and they impair the equipment and destroy the machine. Now that's impaired, and it's the same 7-step process, all things happening all at once. But when we look at it that way, we know when this happens, whether it's a AR write down, an impairment of inventory, an impairment of equipment, we know expenses are going up, the profit's going down, equity's going down, leverage is going up, liquidity is going down if it's AR and inventory, not if it's equipment, and it's a non-cash event recorded on the cash flow statement. All right, I'd like to show this 7-step process here with a little bit of verbiage that you can use and look through, and each step correlates to what's going on in the diagram below. And the only thing missing is that little 6 swirl that starts with 1, then 2, then 3, then 4, then 5, then 6, and then 7. So there's 7 steps, but that little swirl looks like a 6. Helps to memorize the process, but each step is broken out here. So that's a write down, and I also included impairment of inventory, a little way to connect an impairment the same way as a write down of inventory and of equipment as well. So that's a write down, how to navigate it, how to understand it, how to navigate it on the financial statements to know if there's a write down, depending on the size, how much of an impact is it going to have on the financial statements. I did have one example I remember where there was a lot of AR, and then I had a field examiner go in and they saw that $1.5 million of the AR was sitting there for 3 years. And think of the financial statements. AR is a current asset, and AR should not last more than 90 days. We don't like that, anything more than 90s, let alone 3 years. So that should have been minimum moved to long-term assets, if not written off on the income statement, as I showed you that process there. And that's what they ended up doing. But I knew that expense was going to be so big, it really was going to impact equity. As we see in the chart here, equity is going to decrease because of that expense, and that was going to be a major hit to this company's balance sheet. But when we know this process, we know what the impact is going to be, and then we can make decisions based on that. So that's write down, a little bit of an impairment, and that's what you get in the credit library. Thank you very much.